Hi, this is Ray Evans on the Pegasus team at Infinitas Wealth Counsel, and it is toward the end of the year, December 2025, and certainly been an eventful market year and several things to notice, and most asset classes have had pretty good years. Having said that, it's pretty interesting. For really the first time since 2017, non-U.S. has done particularly well. And I'm going to show you a quick chart here that shows you the return over the last 20 years of the U.S. markets in the dark blue, developed markets non-U.S., that's predominantly Europe in the gray, and emerging markets, so Latin America, South Korea, etc., and the returns over the last 20 years. And you can see that the returns over the last 20 years highly dominated by U.S. securities and the U.S. stock market. And here's a different way to look at it, perhaps a second chart that shows going back again 20-some years, and the U.S. outperformance years are the dark blue bars, and the non-U.S. international outperformance years are the orange bars. So you'll see that when one category wins for a year or two, it tends to win for several years in a row. So we're very curious about this. It's been a year where the U.S. has decided to continue to raise their debt levels. We're at $38 trillion in debt right now. And so it's focused perhaps on the dollar being weaker. And when the dollar's weaker, that isn't altogether bad for investments. That makes non-U.S. investments appreciate in value. And so when you sit there and just look at current valuations, the thought perhaps that the U.S. dollar stays weak for a while against foreign currencies is a prevalent thought. But number two, non-U.S. valuations are just far cheaper than U.S. Here is a graph that shows dividend yields in the United States versus other parts of the world. And you can see that outside the United States, dividend yields are, in some cases, 2 and 3 times higher than they are in the United States. And another way to look at this is just to look at common valuation ratios that analysts look at. And you can see that the valuations, whether it's price to earnings ratio, and again, the U.S. in dark blue here, whether it's price to earnings ratio, price to cash flow, price to sales, price to book ratios, they're all much higher in the United States than they are outside the United States. So just from a valuation standpoint, as global asset managers decide where to allocate funds, you can make a great case with the dollar getting weaker and with valuations being much cheaper that allocations in non-U.S. securities should be increased. Happy to visit with you about this and to forward any of these charts to you. If you'd like any of these, ray.evans@pegasuskc.com, and have a great end of the year. Thank you.